That would it be good? I've argued they should stop at 2. They've gone beyond that and let the balance sheet do the heavy lifting and let the yield curve steepen a bit. It's had the exact opposite effect. They've let the balance sheet unwind and they've been hiking. So 3 or even 4 hikes next year, that would be really imprudent.
David, do you agree?
You know, I have a view on this, but after hearing Cramer, I'm worried that I might agree with him, so I'm rethinking it. Look, I think that raising rates in December makes sense for 2 reasons. One is unemployment is headed to 3.4, 3.3%. Fed funds rate is still short of neutral. It's barely above inflation. It makes sense to raise at least one more time. I think there's also a political reason to raise rates to show the president that he can't muscle the Fed into making foolish monetary policy decisions. But I do think that the Fed needs to be very careful about moving further in 2019. The economy is slowing. Inflation seems to be very slow to pick up. And I think that that's what some of them, Rich Clarida in his interview with Steve Leisman, are signaling. When they say data dependent, I think that's a way of saying we're not promising to raise rates 3 times or 4 times next year, as some of you have been anticipating.
Joe, just in terms of what underpins the Fed's existing guidance for 2019 and what they think the economy can handle, what have we seen happen, aside from the S&P 500 being 6.5 or 7% below its high, to really tell the Fed that the complexion of this economy has changed? Whether it's on employment, whether it's on inflation, whether it's on credit conditions, all those things seem like they're holding up just fine.
To some extent. David's point about where unemployment's going, I have that view that unemployment will continue to drift lower, and that's conditioning the Fed to believe that there's this wage price spiral to come, which I don't see happening, but that's their underlying thought process. Where I see weakness, Michael, is in housing. I mean, you've basically had residential investment down 5 out of the last 6 quarters. That tells me that real rates or neutral rates, which aren't even observable, we're actually past the point of neutral. You have seen credit deteriorate. And inflation, the 3-month rate of change on core inflation now is well under 2%. And my sense is with global growth in a lot of parts of the world slowing, the Fed really runs the risk of further flattening that curve and disintermediating the banks, and credit and money creation slows. And that would be a bad sign for growth in early 2020.
David, with all this considered, if the Fed does slow its pace, do you think the dollar's peaked for its kind of medium-term horizon?
Oh boy, I'm not smart enough to predict when the dollar is peaked, and I'm not stupid enough to say it while someone's running a camera. I think, though, that if the U.S. economy continues to be stronger than the economies of the rest of the world, and if people expect the Fed to raise rates, and if the rest of the world seems so shaky that people would rather be in treasuries than something else, then the dollar will continue to rise.